All right, good morning, everybody, and welcome to today's open forum. We have a lot of exciting stuff going on in our industry, as you guys know right now, and we got a lot of exciting stuff in our brokerage in general. But today we have Paul Massey with us from Samaritan Group. Paul is the owner and boss and just one of the best lenders you're ever going to meet. He knows everything that's going on. Paul, thank you for joining us today, and I'll let you take it from here. You're on mute.
Okay, got it. It wasn't working for a second. Good morning, everyone. So yeah, I wanted to talk a little bit about two different things. The first thing that I'm going to go into is Hometown Heroes is coming back. So I don't know if everybody's heard that. It's been out there on social media, but in case you haven't, I'll share some more details with you. The most common question that I get asked is, how long is it going to last for? And no one's going to be able to answer that question. It's $100 million that's being put into the program on July 1st. Okay. You're getting a lot of spam right now from lenders, or you will, that says that they can do these loans now. That is all nonsense. We can all start the process now, but until the program is active on July 1st, no one can fund this loan. Okay. I would actually give it, if you're setting any closings like coming up in the next 30 days, so before July 1st, I would set those closing dates till at least after the 15th of July. Because even though the 100 million will be available and in the system on the 1st, there's always kinks, and it's usually not available until about the start of the second week of July. So do not get yourself in a bad situation with this loan. Okay. So back to the question, how long does it last for? So when it was, when the original Hometown Heroes program came out, where it was just first responders, veterans, the program lasted for a little bit longer. It lasted for 7 to 8 months. With it being available to just about everybody in the state of Florida that's considered a first-time home buyer and veterans, I give it a 90-day shelf life. So anything that we get on top of 90 days is a blessing. So anybody that you have that's on the fence or thinks that this is going to be around forever and wants to wait until November or December, I would instill that fear in them, because it's not going to last that long. It never does. So that's the conversation that I would have. So let me tell you a little bit about kind of the basics of them. One occupying borrower must work full-time with a Florida-based employer, instead of the previous requirement in which one occupying borrower had to work 35 or more hours with a Florida-based employer. Employers determine what a full-time status is. So some employers may determine 35 hours, some employers may determine 40 hours. It just depends what they put on their verification of employment form. With all of these loans, because there's so many guidelines that are kind of off the beaten path of conventional FHA, we upfront underwrite everyone. And I don't care if they're working with me or somebody else. If it's not upfront underwritten, do not start showing them houses, especially if they need this money, because there are so many things that come up after contract, and there's so many debt to income ratios that are very tight right now, that if you get yourself in a bad situation with that, it just gets worse and worse and worse, because these loans are all tight. Self-employed borrowers must have third-party confirmation of full-time status. So if somebody's doing a daycare on the side and they're doing it for 15 hours a week, it's not going to cut it. So there's going to have to be a CPA that gets involved. And if you've ever had to get a CPA letter on any loan that you've had, regardless of whether it's a down payment assistance loan, CPAs do not want to sign off on something unless they're 1,000% sure of it. So again, make sure that if for any self-employed borrowers that we can confirm that it's full-time. Okay, so another thing, income guidelines have recently changed on this program. So before, they were 131,000 essentially in Central Florida. Now they've gone up to, I think 144 is the new number. So you might have had some clients that didn't qualify before that qualify now. So definitely check that out. Let me see if I've got it pulled up for you guys here somewhere. Give me 1 second. I did. Either way, I'll pull that up at the end with the income requirements. I did have it up, so give me a second on that, and we will go from there. So that'll be available again. I think it'll last for 3 to 4 months. Debt to income ratios cannot be any higher than 50% on those, and they typically are getting 5% of the purchase price or 35,000, whichever is less. Okay, so that's going to cover essentially their 3 to 3.5% down payment, and for a veteran, it's going to obviously cover no down payment plus all their closing costs. So that's how that works out. We'll open it up to some questions on that, if you guys have any now, and then we can move on to VA. Does that sound good, Ryan?
That sounds great. I'm excited about all of that. So 35 grand is the max, no matter what, and or 5% of the home.
Yep.
So if you buy a $300,000 home, then 15 grand is the max.
Exactly.
Okay. And so they have, is that just, so they've got, it sounds like they've tightened some of the guidelines and then loosened the one about income. I guess that's just an inflationary thing.
For sure.
So, okay. Well, the money's going, so are they tightening? I mean, this is not something that necessarily, this is just kind of a feel question for you. I know it's not something that they would actually say, but is it just that the money's going so fast that everybody's qualifying for it? So they're kind of tightening the restrictions on it, or are they finding why? I mean, why the 35? I'm just like the 35 to 40 to 32 hours, whatever. I mean, I think the federal government calls you full time if you're over 32. Remember, I don't know if you remember all that, but with the health benefit stuff and all that. But it depends. It has to be a Florida-based employer, and it has to. So, Florida-based, so if somebody works for, started to think of some companies, but they're all Florida-based. Somebody, a national company, somebody works for a bank, a big bank out of, Bank of New York. Obviously, they're not going to qualify.
So let's say they work for BNY Mellon, right? They're a New York bank, but they do have a brick and mortar in Florida. So as long as they have an office, even if you work in Orlando and there's an office in Key Largo, you still qualify at that point. Okay. There just has to be some sort of basis in Florida. And the reason behind that is they want to reward people that are creating revenue for the state of Florida, right? And who work for employers that are. So I think that's kind of the logic behind it. Oh, and I did pull up that income requirement. It's $144,750 for Orange. Seminole is exactly the same, and Osceola is exactly the same. So they're all right there. Okay, and that's FHA conventional, the whole thing.
All right, we got a question in chat. I'll moderate that if you'd like. Within that money, would it include the down payment, like 3.5 for FHA, or 3 or 5% of their down payment, with the rest for their closing costs?
100% accurate. That's exactly the way you want to think about it. Okay.
And so VA, they probably wouldn't be able to take all of it, or they take a certain amount of it.
Correct. Yep. So, but VA, we can alter the down payment too. So let's say that it's $100,000 purchase price, for example, right? And we're getting, it's at that point, it'd only be $5,000. But the point is, if we need to adjust the purchase price to use all of the money, then we can do it.
And they can do buy downs with that?
No, the rates are set by the state and by e-housing, so there is no buy downs.
But I could, instead of, let's say it's $500,000 house we're buying VA.
Yep.
So I could get, let's say I get $25,000 and only have $12,000 in closing costs. Can I just take put 13 more down and borrow less?
Yes, 100%.
Okay.
It's exactly the way to look at it.
Now, explain to us again the payback of that. Is there a payback, or what is that?
Yes, there's 0% interest, and you pay it back when you refinance or sell the home.
Okay, and does it sunset at any point?
No.
Never sunsets. Okay.
Florida's getting their money back. You're just using it.
Okay. Fantastic.
And which is kind of good, because that means the program can exist for the long haul, which I kind of like,
Mm-hmm. Yeah, eventually money will start coming back in, and it won't hurt you to pay it back when your house is appreciated and you haven't been paying interest, and et cetera, et cetera. It's actually been saving you money because you can put more down, et cetera.
Exactly.
So this works similar to DPA, only not third-party approval, county approval.
Yes, which is great because it's all with the lender. So like if you guys have ever done county DPA, So the lender has to fully, love the loan, right? And then they have to send it to the county to hopefully feel the same way. And that can make a 30-day closing 65 days very quickly. So it's not always like that, but there's always that fear of that being the case. So with these loans, the lender underwrites the file completely. So we have complete control over the entire process. We do 30-day closings with these. So it's not like with the seller, you're going to have to negotiate an extra time and make your offer look weaker because you're doing this program.
So Paul, I have a buyer who wants, who's maybe struggling for a down payment. So I'm going to tell them, oh, Hometown Heroes, we're going to be, July, we're going to be ready for this, or we're ready now to start planning for July because it's June 1st almost. So I'm going to set my closing for the middle of July. You just told me that because we want to make sure the money's going to be there. But we can start clamoring for that money now, can we?
Clamoring, we can
start the process. We can
the process. We want to pre-approve it, all of those buyers now, and gather all of their documents, make sure their debt to income ratio is right, make sure everything's perfect, get them completely upfront underwritten. So by the time July rolls around, we are all set and ready to go.
Okay, and that is the best / the only way to do it. And when I say clamoring, I know it's going to be a madhouse when it opens back up. So, but now's the time to start getting in line for that or start getting underwritten for it. So that's my first call is going to be to the lender of my choice, probably Paul, of course. Well, somebody with Paul. So that's, why don't you give us an idea of who to contact for that too, please, if you don't mind.
Yeah, so I would have you contact me. My cell phone number for everybody is personal cell is 407-803-2748, and we'll send it out afterwards too. And my email address is paul@samaritan-mortgage.com.
Paul, give me that number again real quick.
803-2748. 407-803-2748.
All right, I put it in chat. And then
Paul@Samaritan-mortgage.com. Somebody else 100 years ago had a SamaritanMortgage.com email address, and now I can't have it. So that's where the dash came from. But yeah, so we're good to go on that. And then if there's not any other questions on Hometown Heroes, then we could talk a little bit about what's coming with VA. Let me know if anybody has any other Hometown Heroes questions.
Okay, I have, I'm not sure how this works exactly, but I have pinned his information in the chat. So
thank you.
I don't know how that's showing up for other people, but first time I've ever done that. Lisa has a question. And you're on mute, Lisa, if you're trying. Sometimes people accidentally put their hands up, Paul, and sometimes people accidentally don't turn off their mute.
I've been there.
Let me do this question first, and we'll get back to Lisa. With this program, when writing the offers, do we need to disclose that this is for the Hometown Heroes program, or just either FHA or conventional for what the buyer qualifies? Whichever.
Was that Lisa's question?
No, that's Malvis's question. Lisa's having a hard time.
All right. So first of all, that's a great question. It's something I wanted to bring up, and I forgot about it. So thank you. You do not need to disclose that on the pre-approval letter. Okay. So when we disclose the pre-approval, we're disclosing the type of loan that they're getting. On a pre-approval letter, we're never disclosing if there's a gift fund, anything like that. So this would be no different. Okay. So if they're doing a conventional 3% down, that's what we're disclosing. If it's an FHA 3.5% down, we're disclosing that, but we're never putting this on top of it. We're not over advertising that we're doing this program.
Okay. So we don't, it's not a required disclosure.
We don't have to disclose it, and really it just muddies the water if we do,
All right. Lisa gave up on talking. So she's in the chat. Does a buyer still have to wait 3 years to buy using Hometown Heroes money if they owned 2 years ago?
Yes.
Explain that real quick.
So you have to be considered a first-time home buyer, right? So if you bought a house in the 80s and you haven't owned it since then you're a first-time home buyer again, even though technically you've owned a home before. But as long as you have not owned a home or have not been on the deed for a property in the last 36 months, you qualify for the program.
Okay. Fantastic. Thanks, Paul. Would you think a social worker would qualify?
Sure, why not?
I don't know. That was it.
Yeah.
Gigi, please expound on that question if you're interested. Tammy in Orlando has a question.
Hey, so I think what Melvis was kind of wondering, and I'm wondering too, on our contract, would we hit FHA? Would we hit check conventional?
So it just depends on how. Oh, sorry,
Pardon?
I didn't mean to cut you off. It just depends how we qualified them. If we qualified them for an FHA loan, you'll have a pre-approval that looks like any FHA pre-approval you've ever received before, and the same goes for conventional and VA.
Okay, I thought it was like one type of loan for everybody, but it varies. You're just getting the money from the state.
It does, yep.
Okay.
Yeah, and it doesn't really matter, right? Paul, could I theoretically put 20% down if I want and still do it?
Yeah, for sure.
Okay, great. But I can still only do 5% at max.
Yeah.
Yeah, Malvis, I think you might have missed when he explained that they do have to pay the money back when they sell. No penalties, no nothing, no interest. They just have to pay the money back. Up in the deed in the state of Florida, if you have a buyer that came from another state that just sold their home in another state in the past 60 or 80 days, that's not a first-time home buyer just moving to Florida.
They've owned a home in Georgia or Alaska or anywhere in the state, anywhere in the country. They've owned a home.
Okay, what if they're from a different country?
If they're from a different country, then we wouldn't really have access to that information. So
okay,
yeah, Puerto Rico does count, by the way. So I usually get that question.
Okay, wonderful. So yes, Joanne, they do if they're relocating to Florida, as long as they qualify otherwise and they didn't own a house wherever they came from in the U.S. Any other questions on that before we go to VA? Awesome. All right, Chad.
Malvis asked this question, and I think it's important. Do buyers have to pay the money back if they sell?
Yes.
Yeah. We covered that a minute ago. Yes, they have to pay it back, all of it. No interest, no penalties.
One thing I'll say too, guys, from a closing cost perspective, is on these loans, the buyers do not have to pay mortgage tax and intangible tax. So that's 0.55% of whatever they borrow. So that's a pretty big savings. So that's one more closing cost that doesn't exist when these loans happen.
Yeah, on a $300,000 loan, that's $1,600 or something.
Yeah, for sure.
It's considerable. Yeah. Okay. All right, Paul, let's move on to your next subject.
Okay, so VA. So what the heck is going on with VA? Everybody else was pretty quick to come out and say what we were going to do conventional FHA with the NAR settlement. But VA is still kind of figuring it out, and that's pretty much par for the course with VA. So I'm going to just kind of read to you guys a little bit about what's recently happened. And this is as of the 21st, so just, a little over a week ago, right? So the deputy director of VA, her name is Michelle Cordorn, and she was at a mortgage brokers association meeting in New York. And she said between now and June 12th, they're going to come out with a change to their guidelines to allow for some of these real estate commissions. So as soon as that's 100% official, you're going to get it from me. I'm going to give it to Ryan, and it's going to go out to everybody, so you all know. Okay. So I'm just going to read a little bit about what they're talking about with it and kind of go from there. Okay. So it's essentially going to bridge the gap between the VA closing cost rule and the 4% rule, which are two completely different things. VA likes to make it extra complicated for us. So the Department of Veteran Affairs plans to temporarily lift its ban on buyers directly paying for professional real estate representation until the agency deems it necessary to engage in a formal rulemaking process. So that's what they came out with and said on Tuesday, which is not this Tuesday, but last Tuesday. So, which is a huge step for them. We didn't think VA was going to do anything for 6 months to a year, which would have put all of our veterans in a pretty bad spot because their offers, they just wouldn't be represented as well as everybody else, right? So although it's not an official announcement, what I just mentioned, the deputy director met with the, let me see if there's anything new on here. Yeah, there is a couple things that they've proposed with it, and I'm going to pull those up as well. Okay, give me 1 second, and I will do that. But yeah, that's going to change, and we think what they're going to do is right now with VA, you have really there's actually no closing cost concessions rule, which is kind of wild. It just has to be deemed. Typically, you can't do more than 2 discount points, and there's a 4% rule on top of that. Which, let's say you have a veteran that their debt to income ratio is very high and they don't qualify, and if they paid off an American Express card or a credit card or whatever, that it would bring their debt to income ratio down and they would qualify. The seller can give actually up to 4% of the purchase price to offset those costs, which is kind of a wild rule that not everybody knows exists. But what Michelle is saying is those laws are going to be hopefully combined into one, where real estate commission is kind of lumped into it. So I'm going to read kind of what our compliance leader thinks will happen with this and what kind of the common consensus about among compliance folks at big mortgage companies are thinking, and just kind of give you that as food for thought. So this is from our compliance leader, Callie Squire. She goes, "It is not my opinion that it's not completely necessary for VA to update this rule completely, although they may decide to change it and even complicate things a little bit more. In order for veterans to continue to receive a VA loan, VA already allows the seller to pay all closing costs and prepaid items that are common and customary without them being subject to the 4% max concessions. The 4% concession restriction, while it may include some discount points, is above and beyond the interested party contributions that we normally think of for seller paid closing costs. Okay, real estate commissions are typically paid by the seller, so no net changes to this other than the buyer will need to negotiate that they are paid by the seller, which we already know that. It can be left unsaid in the contract once the rule goes into effect, and the realtor will have to get a little creative in their initial buyer broker agreements, all stuff we already know. If it is listed as the buyer to pay or assumed buyer to pay real estate commissions, then the buyer would not be able to get a VA loan in the past. The commissions will definitely need to now be a part of the upfront agreement, and the seller will be able to pay those, or the buyer will be able to pay those as long as the seller deems them necessary and the buyer agrees to them in writing. So again, she's not really saying much, but what she's saying is it should be business as usual for just like we're doing now for conventional and FHA. So again, we're going to stay glued to this till June 12th. We'll see if the 4% rule, I think what's going to happen is the 4% rule and the interested party contributions and the real estate commissions are all going to be grouped into one thing, because now we have potentially 3 different things that the VA could be tracking on this, which is a little complicated. So I know that's a lot, let's ask some questions. Let me unwrap that a little bit for you and we'll go from there. Anybody? I can't hear you, Ryan.
I love it. All right. I did it too. Yeah, they've had a lot of questions for me about this VA stuff. So this would be a great person to ask. Someone wants to know if you can share that link about what Michelle Cordon said.
For sure. I can probably, this is good luck with me doing this, guys, but I can probably share it in the chat. So let me try that. But while I'm doing that, feel free to ask more questions because it's going to take me a second. This was on Housing Wire, by the way, guys, too.
Okay. Vivian, do you have a question you want to speak about, or do you want me to read it out of the chat? I'll ask you this one. If a VA loan is assumed, does the balance have to be with the same lender?
Yes. That's completely separate from what we're talking about, but yes.
Okay.
Thank you.
There she is.
And what she means by that, guys, is if your buyer wants to purchase a property and they're assuming a VA loan that already exists, number one, they don't have to be a veteran. Not many people know that. Okay. So if Ryan was in the Marines and I'm buying Ryan's house and he has this great VA loan at 2.5% and I want it, I do not have to be a veteran to assume that loan. I have to qualify for it, but the loan is going to be through Ryan's lender that exists now, and that's who I'm going to have to qualify for it with. Okay. But the flip side to that is if I'm buying Ryan's home for $500,000, he only owes $250,000 on the existing mortgage. I'm going to assume that 250,000, but I have to now bridge the gap between the 250 I'm assuming and the 500 I'm buying. So I have to figure out where the other 250 is coming from. It's either going to be a down payment or I'm going to have to get an equity loan from somewhere.
Okay, so that's very interesting because it's been a reason the rate increase has been a reason that people want to do assumptions, but at the same time, there's been so much appreciation in the market that there's huge gaps. Have you guys seen? Do you guys handle that, or does it go to whomever is the loan's been sold to, or whatever that is handling those assumptions and qualifying the people for that?
It's the assumption has to be handled by the lender that will be getting a new buyer on the loan, right? So if they're going to give you that 2.5%, $250,000 loan in this example, they got to make sure they want you to be the one paying it back. So they're going to make you qualify with them. Sure. Now, the difference we can 100% do, right? So we can get a home equity lender to do a second. And a lot of times when people think about home equity loans, they think about utilizing the equity after you purchase, right? Like almost like a refinance, but that's not necessarily the case. Anybody who's on this that's been doing this for a while remembers that we used to use home equity loans all the time on purchase transactions. So this is just another version of it.
Okay. And what do those go up to? And I know we're kind of chasing a wild goose here.
No,
What do they go up to percentage-wise?
We have, great question. We have equity lines that go up to 95% combined loan to value.
Really? Okay.
Yep.
I'm surprised by that.
Just to sum up, which loan would take precedence? The original loan that was assumed or the piggyback?
The piggyback is going to be in second lien position.
Okay.
I feel like you knew that when you said piggyback. Yeah. The original one or the one we tacked on. All right. Does that mean interest is at 6.5? That the interest carry on at 2.9 or 2.5 or whatever it was at before? Okay. With the assumption it'll be whatever it was at before, but the equity line is going to be obviously considerably higher.
Yeah. So guys, what we do in these situations, the reason I think everybody's has all these questions about assumptions is when rates were really high, mortgage companies wanted you guys to think, and the general public to think, that this was a way to get in cheap, right? It was a way to get people excited in an otherwise not very exciting market. Okay. But what happens more times than not is when we look at the interest rate that they're assuming, and then we look at the higher interest rate on the equity line that we're giving them, we run what's called a blended rate calculation. So it looks at both loan amounts and it blends what that actual rate would be if it was all combined. And what we find more often than not is it's in the mid sevens, which we can essentially at that point give them one loan, right? That's fixed for less than that. And then it doesn't make any sense to do the assumption in the first place. So we'll always look at it from all angles, because if you're getting a low interest rate, but it's on a lower amount of money and you have this huge chunk at 8.5%, because that's where prime's at, right, guys? Then it's not always the best thing in the world anyway.
Yeah. Yeah. And there's been so much appreciation in the market that most of these low interest ones now that the rates have gone up so much, the low interest ones are going to be lesser amounts. Yeah. All right. Any other questions on the VA stuff? It sounds like, you're saying there's not a lot of certainty there, but it sounds like it's pretty.
Yeah. I mean, I think they're going to follow suit. They have to, guys, because like all of our veterans out there, like it just doesn't make sense for a veteran to be represented in a negative light because they are a veteran, right? Like that's insane. So I'm sure, and this is the first time that we've had a deputy director at the VA that's been pretty outspoken. Usually we don't even know that's a title that exists, and they're kind of more of a hermit than anything else. But for them to come out and say, hey, we're going to come out with this before June 12th, and we're going to essentially bridge this gap between these three rules that we have, it's the most positive information we could hope for. I didn't think we'd hear anything until it got a lot uglier. So this is very, very good news.
I'm sure it was getting pretty ugly because of that, because of that toll disadvantage to veterans, which wouldn't be right. Mm-hmm. Any other? Yeah, there's.
Hey, Paul, this is Clarence. Could you elaborate on the assumption and how that affects the original veteran and their eligibility for future
So
purchases?
Great question, Clarence. It does affect the original veteran's eligibility. So there's an eligibility calculator that we'll use. So if you are a listing agent and you are representing your seller and they're buying another property or whatever the case may be, you need to make sure that whoever they're working with on the purchase from the mortgage side recalculates their eligibility because of the fact that they'll still have another VA loan out there. So it just depends on how much they owe. Now, what I can do for you, Clarence, is I have a calculator that I can send you guys as well. So if you're a veteran and you're in that situation and you're thinking about listing your home, or if you're representing a veteran, or you want to just be a stud on your listing appointments because you're telling people about that, then I'll send that link to you guys so you guys can calculate it very easily.
Thank you.
Wonderful. Thanks, Paul. Great. Any more questions about VA? When a veteran signs on assuming a mortgage to transfer, is he still affected by it? That's what.
Yep, that's the same thing Clarence said. Absolutely.
Ida, that would be great. Paul, please send the calculator. Is that a link you can put in the chat?
I think so, but it might take me a minute to find it as well. So if I don't, I did send the Housing Wire article in the chat for the NAR thing, VA. So
you guys have Paul's email too. Feel free to email him. You can do
I'll
it right
put that
now.
in the chat too. Because
Email him and ask him what you want to know. There you go. Email and anything too. You can ask Paul anything, and he will be upfront and honest. It doesn't have to be real estate related. Just anything you want to know about Paul. He is an open book. What exactly do you mean recalculate? Sorry, maybe was the answer before. What exactly do you mean recalculate? It's talking about eligibility, I think.
Yeah, so a veteran has a certificate of eligibility, right? And they usually get that along with their DD-214. So in that, they only can have so much exposure with VA mortgages. So if they already have one, let's just take the assumption rule out. Okay, let's say we're not talking about that at all. And let's say you have a veteran moving from New Mexico, they have a VA loan, and they're going to convert that into a rental property. So they're not going to get rid of their VA loan at all. And they're going to buy a new primary residence in Florida, and they also want to use their VA. They can 100% do that, but it's going to affect the amount of money that they can borrow on the new VA loan. Okay, so what I can do is send you the way that we calculate those figures so you guys can have it if that situation comes. It's one of those things that you want it when you need it, but you won't need it probably that often, but it's something to just save in a safe place so it's there for you.
That's wonderful. Thank you. That's a great resource. And you answered the question. Fantastic. Any other questions for Paul on the VA? All right. Doesn't look like it, Paul. So this is a question from Ryan, and he wants to know, what do you think the market's going to do? What do you think the market's going to do?
So here's what I think. So the original speculations in the beginning of the year were that we were going to drop rates 6 times. We haven't dropped them at all, right? And so there's that. And by Q4 of 2025, that we were going to be between 5.5 and 5.875. Well, unless we just get started right now, I don't see how that's going to happen, right? Outside of any global change to the market and it being, time for elections pretty soon, I think we're not going to, I think by June of next year, so let's put it a year out, rates will probably be 6.375 with no points. That's my number. I said it here, 6.375 no points within 12 months. How quickly we get there, I don't know if we're going to see any change in the next 30 to 60 days, but I think by fourth quarter of this year, we will start to see those changes.
Okay. So we have, there's been a lot of talk about the election and stuff over the time that we've been doing this, and people have been asking me and you, I know they've been asking you a lot more than they would ask me, but every lender is being asked that question, I'm sure, what they think is going to happen with rates, even though nobody knows for sure. And everyone references the election, but what they've been using to not lower the rates, not what they've been using, they've been dying to lower the rates, I think, as an administration, but
sure.
but this, because they want to kickstart the economy, but this inflation is, they're kind of caught between a rock and a hard place with getting bashed over inflation or getting bashed over keeping the rates up. So, and you can't do both. So, you can't cut rates and inflation's already not coming down like they hope. So I think that's kind of where we're at. And that's why the rates are just sitting there, because they want to, but they can't.
Yeah, it's been interesting. One of the big reports that affects us in rates is the jobs reports too. And those speculations have been, guys, if we all got together and said what we thought US jobs were going to do, I would think we'd have better accuracy than the people that are paid to do it right now. It's pretty bad. So as soon as we think we're going to have a leeway with rates and a CPI report comes out or a jobs report comes out, we get absolutely crushed. So that's the spike that we saw about 30 days ago. Hopefully we get a little more in line with that. And there's a lot of theories on why they're so off. But that's a conversation for another day for sure. But yeah, that's why I think we're not going to see anything at all for the summer months, and we're not going to see any reprieve rate wise until Q4 of this year, when the market typically cools down.
Okay, when did you tell us this? I wrote down the 6.375, but I didn't write down the date.
I think it's a year out. I think June of next year. So we're about 7 now, and some lenders will tell you we're lower than that, but they're going to wall up your buyers with points. So we're all right around 7 right now. So I think by the end of this year, we'll probably be around 6.5 at the end of the year. And then we'll probably slide into the 6.375 range by middle of next year.
All right. That sounds wonderful. What in your estimation, and this is a little something you'd be a little more accurate about, what do you think that dropping 3/4 of a point would do to demand right now and mortgage applications?
I think mortgage applications would certainly go up. I think we have a lot of sellers that are stuck, right? And you guys experience that way more than we do. But you have a lot of sellers that don't want to cash in their 3% rate and essentially double what they're paying in interest, right? For another property. So I think it'll free the market up. It's a delicate balance, because if rates are too low, it'll be really good for all of us for a very short amount of time, and then it'll get really, really, really bad. Okay. Because there'll be so many buyers entering the market, so many sellers entering the market, and then we're always going to have this inventory issue, I feel like, and for the foreseeable future. And with that being said, it's just going to create higher and higher prices like it did a couple years ago. So I think a healthy market is in the 5.875 at the absolute positive lowest number to 6.25, I think is healthy. That 0.5% medium ground. So anything lower than that is going to create chaos, and anything higher than that is going to keep us moving slowly. I don't know if I answered your question, Ryan, but that's.
Yeah, I think you kind of did. I don't know how much it moves the needle, because they're still getting out of a 3.25 to 3.5 into a 6.5.
Yeah.
And but people have life events. They have to move. That's why we're doing business right now. That's why we're all here, marketing and selling right now. And, we're doing pretty well. We had a really good month in April. It looks like May is going to be really good. There are life events, kids are graduating, people are moving on. They need different houses. They need to go different places. So people are buying and selling, but the average person who, would like a nice house, want to move to a different neighborhood, just haven't done it yet because of the interest rates. And they'll call you, or they'll call Lisa, and Lisa will put them in touch with their lender to get pre-qualified. And they're like, whoa, it's way more than we're paying now. And so I think that they don't want to cash in on their equity just yet because of the rates. But I think there's a lot of pent up demand. And so maybe, 3/4, half of or 3/4 of a point will get them moving. A lot of people moving, obviously. But I just didn't know if you knew if you kind of put a not a number on that necessarily, but maybe a percentage increase in mortgage applications, which is, what drives that's a number I use what drives purchases.
Yeah. So, and as far as mortgage applications are concerned too, I'll say this, like when we were peaking in probably like, June, July, August of 21, we were at about personally 100 mortgage applications a month. Okay. Now we're at about 60. So we're down, you know, about 40%, right? So to put it in a percentage, I think if we were in that 5.875 to 6.375 range, I think there's so much pent up demand and people are just so raring to go that just that drop would at least bridge that gap by half. And I'm being forcibly conservative on that because I think people are just, they're just ready to go for sure, you know?
Yeah, they've been waiting and waiting and waiting. And they're ready to go. Yeah, and back then I think it's important because business isn't down 40%, not for us, which is, you know, the actual, yeah, and I don't know if it is down 40% for you, but a lot of those people were getting pre-qualified back then, couldn't find a house. So they weren't buying anyway. You know, of those 100, maybe 80 or 90 were buying. I don't know what your numbers are, but it's down, you know, we're down maybe, well, it's hard for us to tell because we keep growing, you know, more agents, but you know, per agent, it might be down, you know, 20% from that. Well, I got a question for you. Malvis had her hand up first. Malvis, go ahead.
Yes, I have a question for Paul. I actually had a buyer ask me this question. I didn't know how to answer. So, you know, in the assets contract, when realtors put in an offer, there's a place where we can put in whether, you know, it's FHA loan, conventional loan, and there's actually a box that we check to either have the buyer take the interest rate that prevails at the time, or we can put a number in there. Let's say the buyer is willing to pay 6.5%. So we can put, you know, 6.5% in there. If the rate then comes up at 7, the buyer it's a way for the buyer to get out of the contract. A buyer asked me the question that, let's say my credit is excellent and, you know, I have down payment, I have excellent credit, and the lender is actually giving me the option to purchase at a 5.5%. But I will be willing to pay 6.5. The fact that we put in 6.5 in that box, would that make the lender give the buyer a higher interest rate when the lender can actually give them a 5%?
No.
Would that, no?
Not even
Okay.
close. We don't even look at that box. So number one, we don't care. Number two is if we did care and we went, oh, it's 7.5%, let's give them 7.375 and call it a win. They're just going to shop us and go somewhere else and we're going to get crushed. So we don't pay attention to that box, but I'm glad you mentioned that box because that box is actually very, very, very important. Okay. So here's why I say this. I had a friend who had a client last year. They left that box blank, which is what 90% of everyone does, okay? Because they want it to just go to prevailing. So the client was supposed to qualify for, you know, a conventional loan at let's call it 6.5%, whatever it was, right? And they didn't qualify for that conventional loan, but they did find a non-QM loan, essentially like a subprime type loan for them at 8.5%. Well, the buyer said that they don't want that rate, even though they qualified for it. Right? So they canceled the contract. The seller kept their escrow deposit because that box unchecked means that whatever is prevailing and customary for that type of qualification. And there was $100,000. Okay. So explain that box to your clients. It could not be more important. And it's something that even though I've done this for a very long time, I did not know that was the case. And the buyers got absolutely crushed from it. So it doesn't affect us in that way, but I'm glad you brought it up because it is a very important box and it's something that protects your buyers.
Yeah, that's something that your director of sales at FRI tells you to put in there. And if anything, put the rate they were pre-qualified for and maybe even a little lower, and it protects your client.
Yeah, because if it goes up, let's say if I am buying my own house and I am willing to, okay, let's say I'm willing to pay up to 6%. Just because if you give me a higher rate, that doesn't mean I can buy. I can still accept that. But you as a lender will say, okay, hey, Malvis, you know, you are worth 5%. But because you are willing to pay 6%, I'm going to give you a 5.75.
Yeah, no, we don't.
No,
we're
not looking at that now. But
yeah, we're shocked so hard, guys, on every loan. It's hard out there for us because we provide value in our approval letters and our reputation in the market, and a lot of lenders like myself do. And we get crushed by somebody working in Kansas City in their grandma's basement that closes 2 loans a month, that runs on 0 margin. So I wish that we had the luxury of looking at that box to choose how competitive we were going to be, but we wouldn't anyway, but we 100% don't have that luxury.
Malvis, they should already be pre-qualified for a certain interest rate anyway before you write that contract. But no, the lenders aren't going to do that. But yes, kind of to look at it the other way, if I write in there, let's use today's numbers. If I write in there 6.875, and by the time they get through underwriting and stuff, they're at, sorry, they get that phone call. Sorry, you guys are going to be at 7.125. We can still get our loan approval at that and still close if we want to. And if it comes in lower, we can close at that too. But it's up to the buyer at that point. That's between the buyer and seller. I mean, Paul's going to see it, but he's not going to raise your rate because of that. So
honestly, I'll see it if I look at it, but I'm probably never going to look at it.
Right. It's for us. It's for realtors to protect our clients. It's not for lenders. Don't care. And it certainly they can't affect their rate. And they certainly wouldn't raise somebody's rate based on that.
But it is a great question because it can really hurt someone.
Yeah. And you shouldn't leave stuff blank in your contracts. Okay. Any other questions on this? Paul, you've been absolutely amazing. You guys have, we're going to do, oh, here you come. One more hand. Go ahead. And I'm sorry, I don't remember who O2 Superbike is, but you're up. And your mute is on.
We'll get there.
All right.
Hello. I'm sorry. I was trying to get that mute off. Yeah, I'm just wondering, like I come across sometimes with buyers that they are undecided whether to go with new builder or a used home. And I've been asking a question. They say, okay, well, new builders, they have a incentive as a better interest rate, less than the average market interest rate. What can let's say Paul, do for me to beat the new builders as far as the interest rate?
So good question. It depends on a couple different things. So it depends on how big the incentive is and how large the loan is. Okay. So for example, if somebody's borrowing, and this, I'm just speaking in general terms, but if somebody's borrowing less than 350,000, and they're getting
to interrupt. I'm going to give you more specific.
Okay.
I have this buyer. He's looking at KB Homes in Sanford. The property with the lot and the house and the upgrades, it's about 460,000, more or less.
Okay.
And they're saying it's just too much money and they're better off buying a used house. But they're debating because it looks like they're possibly getting a better interest rate with the new builder. So that's more in a specific case right now that I'm going through.
On top of the lower interest rate, though, are they getting a closing cost incentive, incentive at the design center, or is it just strictly rate?
They're offering closing cost and interest rate.
Okay. Well, it all depends on what the closing costs are, right? Because that number can be vastly different, just depending on the situation. But so first, let me explain to you why builders are doing this. Because if the rest of the mortgage world's at 6.875 to 7.125, how is a builder offering 5% or 5.5%, right? So it's called vertical financing. So if Ryan has a subdivision of 100 homes that he's going to build, he can go out into the market and say, hey, I think if people finance on average, 80% of these homes, and I can sell them at 5.5%, then I can probably finance as my builder mortgage company, 90% of those transactions. So based on the average of what people borrow, I'm going to go out into the market and grab that chunk of money and say that I want it at 5.5%. because I'm going to deliver that. It's called mandatory delivery, right? So that's why they can offer those rates. It's not that those rates exist and we don't want to offer them. It's because he's doing it a different way. So for us to offer a one-on-one situation, which is why most mortgage companies say, absolutely not, tell them to go with the builder. We don't have the luxury of going out there and buying that huge chunk of money at that interest rate, right? So the reason it matters on how big the loan is because the bigger the loan, the more money that we're going to make as a lender, the more profitability we have to play with, and the more we can invest into buying the rate down to try to be as competitive as possible. But I can tell you right now, if it's in the mid fives, we're not going to do it. I mean, that would cost us 300 basis points on a conventional mortgage that we're only making 337 on, and that's before we pay any of our staff. So we're not going to lose money to close it, so we're probably not going to do it in that situation.
Okay. What is the roughly? I know they probably have to fill out an application and whatnot, but what's the roughly interest rate right now for a VA loan?
VA is a little better. It's probably going to be around, without paying any points, probably going to be around 6.375.
Okay. All right. Thank you.
That's pretty good. And Paul, it's you know, I've heard you say that before, and any lender I've ever talked to has said, you know, just tell them to go with the builder, because they, you know, they can do that based on their volume, and they give all those incentives and they give this and that, but they're making a ton on the build, and they're doing it. You know, they're it's not necessarily their only profit center there, obviously.
It's a very incestual relationship for sure.
Yeah, it sure is. Ann, go ahead.
Yes, my husband is VA. We live together here in this house, but if we buy another house, we still keep this house. Can he be able to use his VA on a new home and rent this out, or he have to refinance this?
Yes, and that calculator that I'm going to send out after will tell you exactly how much you can borrow, but you can also just call me, Ann, and I can do the numbers for you. So it's not a big deal. All I need is his DD-214 or certificate of eligibility.
But can he be able to use a VA on a new house?
Yes.
Or keep this?
Both.
Oh, nice. Okay. Thank you.
Yep, no problem.
Yeah, that's you know, you're answering that in theory. I mean, there could be problems with the calculations.
Yeah, I mean, you probably won't get 100% financing, but sometimes you can get 5% down, which is great. So we just got to run the numbers.
That's fine, as long as we can use that as primary resident, and for he doesn't have to pay tax because he's a VA. So is it we don't mind to put down?
Got it. You're fine then.
Okay, and who can rent this property, or we have to refinance?
You don't have to refinance, no.
Okay, great. So
yeah, the question you're really driving to over again is, can we have both at the same time? And the answer is yes.
Awesome.
All right, fantastic. Any other questions? So Paul's number is in, and if you want to look up there, I've hit pinned, but it's in the chat. Chat's not too long anyway, you'll find it, but I pinned it. I don't know what that means, what it actually looks like to you guys. There it is again. He just put it in again. Ida. Ida, you.
Yes. I just wanted to share, piggyback on what Ann Nguyen was mentioning. I'm also the wife of a veteran, and if you buy another property, remember, for homestead purposes, one of the property must be your primary residence. You must live on that property in order to get the homestead. You will not get homestead on the rental unit. Is that correct, Paul?
Yeah, that doesn't have anything to do with me, but that's 100% correct.
Yeah, that's for anybody.
Yeah.
Yep, that's correct for anybody. Every year when you file that, or when you file it, that you are filling out an affidavit that you will live and occupy that property that you're getting homestead exemption on for more than 6 months and a day. Can I get a recommendation for a good CPA for taxes? Sure. Yeah. All right.
Langley's got somebody. I've got somebody. So
I have somebody too.
Everybody needs somebody. Perfect. Ida, I bet I know who yours is. Who's yours, Ida?
Oh, mine is awesome. You want mine? I can
just-
share it on the
what-
here.
Yeah, go ahead. I'm just guessing that I know who it is.
Oh, really?
Yeah.
Okay,
Yeah.
mine is Kishore. Do
Okay.
you know him?
Nope, that's not who I thought it would be.
Oh my
Um,
God, he's awesome. I'm gonna put his name here.
Yeah, I'll send my guy too. He's the reason that I like him is, first of all, he doesn't look like an accountant. He has long red curly hair. He looks more like he should be at Woodstock than running numbers. So he's very, very down to earth and knows how to explain things to people very simply and not like an accountant normally would. And he's also a real estate attorney. So when you're talking to clients about how they should set things up for buying investment properties and so on and so forth, he's a very good resource. But I'm sure, you know, Ryan's got somebody that's great too, but just wanted to say that.
Oh, these are all great. Daryl put someone in. I know her as well. She's great. Wonderful. Everybody just put your people in there. Great. So the other, Sunina, those are all good suggestions that are in there.
Also, guys, accountants are a very, very good referral source too.
Yes.
Accountants and financial advisors. Every time that I talk to any client, I ask them on a scale of 1 to 10, you know, how would they rank their financial advisor? And if it's anything below an 8, I'll ask them if I can refer them out to my financial advisor. I do the same thing with them when I ask them about their accountant, because once you start getting those leads flowing into your financial advisors and accountants, it's an undeniable lead source for you. And when a financial advisor tells their client that they should talk to you as a real estate professional, there's not really a better referral source. Those people are absolutely married to you at that point.
Guys, if you learn nothing more from this today, that is genius advice. I love that. Rate your financial advisor or anyone that you're going to refer people to. Ask them who theirs is, and whether it be an accountant or a financial advisor, and how do you rate them on a scale of 1? Yeah, if they think their financial advisor is a 6, that's not a ringing endorsement at all. They're definitely open. All right, Sunina.
I needed the number for Kishore. I think I'd put it out. And Daryl, do you have Preeti's number? Are you all using this CPA personally?
The one that I put out, yes.
I use mine too. That's who does my taxes.
Okay,
Okay.
what
I
about you,
get paid.
Daryl? Okay, thank you for the recommendation. I'm looking for one because mine is, I don't know. Do you?
I'll see if I can
Daryl?
find your number. I'll see if I can find your number and put it on the chat.
Okay. And do you use her personally?
Yes, I've used her for years, like 8 or 9 years now, and she's really good with investment properties. She does the taxes for hundreds of top producers in town too, so she knows her stuff.
And she,
Okay.
yeah, I
Okay,
just
good.
Googled her. She's on here. She's Rick's wife, I think. Yeah, she's real good. She's good with FERPTA too. I know that. She's done a bunch of FERPTA stuff. Okay.
Thank you. Thank you,
You bet.
everybody.
All right. Paul, it has been an absolute pleasure to have you here. I know you're taking a selfie, but it's been an absolute pleasure to have you here. You've been wonderful. Any other questions for Paul before he goes? I'd like to wait to the last second to make sure nobody else is going to ask their question so they don't have to.
I'll tell you about one last thing, one cool program that's out now. You know, investors have always had, well, not always, but most recently have had DSCR to bridge the gap for not, you know, showing income sometimes. There's a new program for primary homes, because with DSCR, you can obviously only use it if you're an investor. As long as they put at least 25% down, we have no income verification at all whatsoever. They just have to have 6 months of reserves. So if you have anybody that might not fit any other mold, you know, just consider that as a program option.
Really? Okay.
Yeah.
That is
How is
interesting.
the interest rate?
It's high. It's going to be in the 8s, 9. 7.5 might be the lowest, but they're going to have to put a substantial amount down. But it's going to be between 7.5 and 9.5.
And they got to show, they got to source that more that money came from, Paul, for both of those, the 25 and the 6 months.
Correct.
How long do they have to have that in their account?
60 days.
Okay. No further questions, Your Honor. All right. Anybody? Oh, Juliana has a question. Very excited.
Loving the questions, guys.
I do too. Let's go, Juliana. What do you got? There you go.
Just a random question. Regarding appraisals, what do you know about appraisals? I have a buyer right now. She's going through her approval, and they're charging her $850 for the appraisal. Are appraisals going up as well?
No. How big is the transaction?
It's not that big. It's for $270.
Yeah, that's insane. Is it like
Right.
50 acres? Like,
No,
what's
it's a small
missing?
house. It's not even a house. It's a duplex.
Yeah, that's a lot. That's very high. So
They're justifying that on 425 a side, maybe?
No, they're just saying that appraisals have gone up.
no, that's nonsense.
But I
So
don't think that's the case.
So it's, there's some companies have appraisal panels, which is what we subscribe to. And some companies go to appraisal management companies, AMCs, right? So whenever you deal with an AMC, they're getting a cut of the appraisal as well. So when Dodd-Frank happened in 2010 and our whole world changed, right? The appraisers probably got taken advantage of the most, for lack of a better word. With that, these appraisal management companies were created, and they take a chunk of what the appraiser makes. So there's an increased cost in appraisals in general since 2010. I mean, it's been a while now, but $850 or $825 or whatever you said is insane. I mean, that appraisal shouldn't be more than $485, but is it an investment purchase or a primary purchase?
It's an investment property.
So there's also something called, anytime a person purchases an investment property and they're using rental income from the unit to qualify, which is most times, there's an additional form an appraiser has to use called a 1007. It's a comparable rent schedule. So that is always going to be more expensive. So let's say $485 is reasonable. $150 comparable rent schedule is also reasonable. So that appraisal shouldn't be more than $625 to $650. It's still way too expensive, but not as dramatic as I thought before.
Okay, yeah, because they were quoted first at $575, and they charged their credit card. But after the weekend, they came back and said, "Oh, the appraisal, the price is higher. It's gonna be $850."
Tell them to beat up the lender. Who's the lender?
To be on the lender. Okay, they are actually, they're not in Florida. The lender's not here in Florida.
Oh yeah, tell them to give them hell. Yeah, just say, hey, we're gonna go with somebody else unless you honor that original.
Right. Okay. Yeah, we'll do that. I'll tell them to do that, because
there's just not a reasonable explanation for that. If there is, I would defend it.
Sounds like they're doing maybe 150 a side on that, Paul, or something like that.
Yeah, that's insane. It's one comparable rent schedule.
No, the whole thing's insane. I mean, we do that, or how I evaluate investment properties is that if I had to give you a CMA on that duplex, I'd have to do the rent schedules and figure out what it's worth from that, and that would take.
Also, the bigger question: where are they buying a duplex for $250? I need to get in on this.
in Orlando, actually, near downtown, the Conway area.
Okay.
But it's not a duplex. The property itself is a duplex, but it's split in. So they have
they're only doing one unit? Yeah, okay.
Yeah.
Then that's even more insane. Yeah.
No, that is, yeah.
Yes.
Sounds like they can flip it to Paul though if they want. Anne, go ahead.
Yes, I have two questions. My first question, can you do 12-acre with a mobile home on it? Can you do loan?
Yeah.
Yes. Okay, that sounds good. And another question, I have under contract right now. So the property is kind of this is more for the roof, old roof. The roof is really old, so the seller willing to give the credit, but my question is, will the insurance willing to sell to get for the buyer to get the loan? So yeah,
I can't. I'm not an insurance professional, so I can't say, but I do play one on TV. But I can't. So I can't say 100%, but what most insurance companies I've seen do in the past is if that's in the contract and there's an addendum for it, and the roof will be replaced within 30 days after closing, most insurance companies will write that policy and just have somebody come out and ensure the work's been done.
Okay. Or anybody in the group know the group willing to do it and pay at the closing? Please share.
Also, what you need to make sure of, if there is financing on that deal, some lenders freak out when they see that there's a roof being replaced, and they won't do it because most lenders will make it be a what's the word I'm looking for? They'll make it become an escrow holdback, where they'll hold 150% of the value of the estimated cost of that roof, which is what we would do in that situation. So just make sure that you don't think everything's okay and run into that issue.
Okay. Thank you.
Mhm.
Sunina, did you have a hand up? Okay, I saw that. Any other questions for Paul? Any other questions for Paul before he goes? Going once, going twice. All right, Paul, you have been absolutely wonderful as always. I really appreciate it.
Thank you.
Enjoy your fishing trip with your father-in-law this weekend, and really happy for you, and have a lot of fun, buddy.
Awesome. Thank you guys so much. Appreciate you. Have a great day.
All right, guys. Paul is going to, well, he just left, but give him a call if you have any questions and stuff. He's very, very helpful, as you can see. Yeah, I know a lot of roofing companies will do that. I don't know off the top of my head, but a lot of roofing companies will get paid at closing, as long as there's a contract and everything else, so you can prove what's going on. Any other questions before we go for our company? For me?
Ryan, I have for you the builder I asked for about 12 to 14 condos. I have a client that they want to build in Lake Mary. They have a lot which is already approved. I'm just looking for a builder.
Okay.
2 to 3 bedrooms.
Okay. Well, that shouldn't be hard to find people to do that.
No, I need recommendation. Referral means somebody who's done it and
For
not just Google
multifamily?
it. Huh?
Multifamily, you talking about
Yeah, they
multifamily?
want to do, but they're approved only for 14 units in that lot that they have.
Okay. All right.
And would Paul do
it's
financing
a
for
small
something like
project.
this? It is a small project. It is.
Well, so the problem with small projects, and when I say small projects, most multifamily builders want 40 units or more for the economy of scale of marketing. So they can put, it makes more sense to do all the marketing and signs and the this and the that for a little bit bigger project. But there's always somebody that'll build that. There's got to be money in it for them, and they'll build it.
No, so do you have any recommendations? Because I
In
don't
Seminole
want to look
County,
at Google.
I don't. A small builder in Seminole County, I don't.
No, okay.
I don't, but some other people might.
What about Orange County?
Put your contact info in. Other people might.
Okay, I'll just
There's
put my
one.
phone
Dave
number.
Briarhill is in there. Talk to Vivian about that.
Who's that?
Check the chat. Vivian just put someone in chat.
Okay, so should I just put my phone number?
Yeah, please.
Okay, will do. Thank you so much.
All right. Any other questions for us? No, I won't call you. Vivian, just give her the information in chat. And Sunina, you can Google Briarhill Homes. Any other questions? All right, guys. We will see you next week. We'll have another exciting program. I really, Paul did a great job. I hope you guys learned something from that today. I do feel better. We'll get to your question in just a second. I do feel better about this VA thing. I was worried about that. A lot of us were. It's good that has come out. And obviously, it is wonderful that that Hometown Heroes is coming back in. Someone just raised a hand. Was that you, Vivian? Who raised a hand? Yes.
Do we know what the timeline is on the new project?
Yeah, it's coming soon. A lot of accounting stuff going on, lots of stuff going on. And there's something even more exciting coming down the pike as well for all of you guys. And I'm not letting any of the cat out of the bag. But there's something exciting coming down the pike. All right. Yeah, you're going to love it. It's going to save you some money, make you some money. All right. I will see you guys soon, and have a great week. Bye, everybody.